Hello and welcome to Commercial Lines Introduction to Excess and Surplus Lines. Today we're going to talk about the excess and surplus lines marketplace, some of the reasons why we approach and have to gain proposals and policies through the excess and surplus lines marketplace, as well as some of the procedural and operational considerations, and lastly, some implications of doing business both for us as agents as well as for our clients when we write policies in the excess and surplus lines marketplace. So again, this course is intended to be just an introduction to the role that excess and surplus lines plays in the commercial insurance marketplace. It's not intended to be a comprehensive deep dive into every aspect of excess and surplus lines coverage and procedure, but rather the course will highlight general concepts and a high-level review of the reasons for the excess and surplus marketplace, procedures for interacting with the excess and surplus markets, and operational considerations and implications of writing excess and surplus lines commercial lines policies. So what is excess and surplus lines, and what do we mean by that terminology? And essentially, this is a conversation around admitted and non-admitted insurance carriers. And so let's start by defining each of those. An admitted carrier, often referred to as a standard market carrier. And to qualify as an admitted carrier, an insurance company must file an application with each state's insurance commissioner and be approved. Approval requires compliance with the state's insurance requirements, including the filing and approval of that company's forms and rates. And this process often takes a long time. Once a carrier is licensed to transact insurance business in any state, the carrier is required to pay a portion of its income into the state's Insurance Guarantee Association. And one of the main selling points of being admitted is that the carrier's liabilities are backed by that state's guarantee fund. If an admitted company becomes insolvent, the state will help pay off policyholder claims. Okay, so what's a non-admitted carrier? A non-admitted carrier is often referred to as an excess and surplus lines carrier and operates in any state without going through the approval process required for the admitted companies. So non-admitted carriers are not bound by filed forms or rates and are therefore have much greater flexibility to write and design policies to cover unique and specific risks and to adjust premiums accordingly. When standard markets can't or won't write a risk, or when an admitted carrier cannot offer appropriate terms, the non-admitted marketplace is available to help fill this gap. And so the take-home message for this is that admitted carriers file their forms and rates and are protected against insolvency by the state's Insurance Guarantee Fund. Non-admitted insurers do not have to file their forms or rates, but they are not covered by the insolvency funds, the guarantee funds against insolvency. But that also means the E&S markets are much more nimble, and they are available to provide coverage that is not obtainable in the admitted marketplace. They can offer us highly customizable insurance policies that are tailored to meet the specific needs of our insureds and are oftentimes our only or our best option for new, emerging, or high-risk types of businesses. So let's take a moment now to rethink again when we would approach the excess and surplus lines marketplaces. So let's think about point number one. This is where we are working with a type of risk or a type of business that is widely acceptable in the standard markets. However, our specific risk that we're trying to quote has a very poor loss history, and therefore we will not be able to get favorable terms or even maybe any terms at all from the standard insurance marketplaces. So let's think about this in more practical terms. In this instance, we might have a risk like a casual dining restaurant, which is a widely available type of risk to be written with our standard admitted carriers. However, the specific casual dining restaurant that you're working on has had a lot of losses, or maybe has had some severe losses, and therefore the admitted markets are saying no thank you to offering terms. We will have to go to the excess and surplus lines marketplace in this situation in order to obtain coverage for our casual dining restaurant. So point number two, this is almost the inverse of point number one. This is where we have a risk that we're working on that has a squeaky clean insurance loss history record. They've never had a claim. However, they happen to be working in a risk industry that either has a high propensity for frequency of loss or high propensity for severity of loss, and therefore our admitted markets typically will not underwrite or offer terms to that entire industry segment. So we can think of a risk kind of like a commercial roofer or a residential roofer contractor. And even if your roofer has never, ever, ever filed a claim and has never had a loss on their history report, our admitted markets might say to themselves, we do not underwrite roofers because as a class, as an industry class, when they are susceptible to having a lot of losses, so high frequency, and when they do have a loss, it tends to be very high severity, so it's a big loss payout. And so therefore, we don't really care that this individual roofer has never had a loss. We're not going to offer terms and conditions, and therefore, the only place that we'll be able to get coverage for that roofer will be in the excess and surplus lines marketplace. And then the third time that we really want to go to the excess and surplus lines markets is when we have a rare or unique risk and therefore essentially not enough of them out there in order for an insurance carrier, a standard insurance carrier, to apply the law of large numbers so that they can actuarially underwrite the account and price it appropriately. And so they'll just say no thank you. So a common or a specific example of this might be sort of a hot air balloon touring company being run out of Albuquerque, New Mexico. Yes, we can potentially try to underwrite that and get a quote and a policy written for that type of a risk, but it's going to go excess and surplus because the operations of running a hot air balloon touring company just are not widely applicable to a lot of different businesses, and therefore there's no law of large numbers, and our standard admitted carriers will say no thank you to offering terms and conditions for that. And so we'll really be looking to the excess and surplus lines markets to help us out in that scenario. So when we talk about the excess and surplus lines process, there are some concepts that we really need to pay attention to and review. And the first is that in order for us to access excess and surplus or non-admitted carriers, we must work through a wholesale broker intermediary who has a special wholesale or a special excess and surplus lines license to be able to access those insurance carriers on our behalf. And we will need to be supplying that wholesale broker with a full manual submission. So ACORD applications will have to be submitted, loss runs, supplemental applications, and all the rest of it will have to be provided to that wholesale broker. Now, the wholesale broker will approach many different insurance carriers on our behalf, and so we have to pay attention to that because that wholesale broker has a first right of refusal, or essentially the carrier has the first right of refusal, so they will block multiple wholesale brokers who attempt to approach them with the same risk, very similarly to how we may be blocked with insurance carriers if it's already being quoted by another agent. So we want to pay attention to that, and we'll dive into that in a little bit more detail. In addition to our full manual submission, we will need to complete a due diligence form. And essentially, a due diligence form means that we've attempted to secure coverage for this risk in the admitted marketplace with the standard markets, and however have not either been able to find terms, so we've gotten declinations, or we haven't been able to find the right terms for our insured. And so we'll need to present that due diligence form along with our manual submission to our wholesale broker, which will allow that broker to access the excess and surplus lines markets for us. Do know that in the admitted space, when we work directly with our carriers, we typically are granted binding authority up to certain limits of insurance. However, when we work with the wholesale brokers in the excess and surplus lines markets, we have no binding authority. We must request binding of the wholesale broker, who must request binding with the carrier. So we are never allowed to bind a carrier to the coverage without informing them and getting approval from the carrier first. Additionally, excess and surplus lines policies will always come with what's called a minimum premium earned. That's going to be attached to the premium discussion of the premium on that policy. And what a minimum premium earned is a certain percentage of the total policy premium is going to be earned at binding or at inception of that policy. And the minimum premium earned can be anywhere from 25% to 50% to even up to 100% of the premium on that policy can be earned the instant that the policy is issued. What that means for us is that there is no such thing as flat cancellation in the excess and surplus lines world. If our insured essentially secures coverage for a month and then cancels, there will still be premium owed on that policy. And we'll talk a little bit more about how that's handled when we get into the agency bill discussion. Do know that taxes and fees will be applied in the excess and surplus lines policies outside of the policy premium. And so when we work with the standard carriers, all of the taxes and fees are typically paid as part of the premium. In the excess and surplus lines world, they're collected outside of the premium, and it's going to be our responsibility for collecting them. So this is when we're talking about agency bill and the process of what agency bill is as opposed to direct bill. So direct bill is something that we do when we work most of the time with our admitted carriers. And what that means is that the insurance carrier will directly bill your insured for the premium on that policy, as well as any taxes, etc. And essentially, you as the agent are cut out in the process of collecting premiums. Now, we may have to track down an insured and have them make a payment to a carrier, but oftentimes that requires them calling the carrier or logging into a carrier portal and remitting payment directly to the carrier. Very rarely in those instances do we collect any premium from an insured and remit it to a carrier. It's always a direct relationship between the carrier and the insured. However, agency bill is completely different. In the agency bill scenario, we as the agent are responsible for collecting all premiums, taxes, fees, and commissions due on a policy and then remitting that payment of premium to the insurance carrier. And so do know that when there's minimum premium earned considerations, we as the agent are always responsible for paying the insurance carrier, and therefore we want to make sure that we're getting paid by our client before we bind coverage, and we'll talk about that a little bit more. Last thing to consider when it comes to payments and billing is that excess and surplus lines policies are typically pay in full policies all the time, which means that when we get into higher premium policies, our insureds may be looking to us to help them break that full payment into monthly installments, which means we're going to work with a third-party intermediary financing company that will essentially offer a loan to our insured to pay the full premium of the policy, and then our insured will satisfy the requirements of the loan by making monthly payments to that financing company. So that is something that we see a lot in commercial lines, excess and surplus lines as well, is that we will bind coverage, we'll have to collect a down payment from the insured, work with a finance company, the finance company will pay the insurance carrier, and then our insured will be paying the finance company over the term of their policy in order to pay off the loan that originally paid the premium for that policy. So let's take a moment to review the commercial lines channels. I like this graphic. It really makes it very clear about when and how we work with different types of risks. And so if we start on the left with our insured, they're going to bring to us a need, some need for insurance coverage, and we are the retail independent insurance agent. If we're working with a standard type of risk, we're going to go directly to that standard admitted carrier. We're going to quote coverage. We are going sometimes online, sometimes we'll do a full manual underwriting submission to that carrier's underwriter, and we will collect proposals from the insurance carrier and we'll propose them to our insured. And then if everything looks good, we'll bind the coverage and we'll notify the carrier that we have bound the coverage. Okay. And so the carrier is going to be bound to provide the coverage that we've told the insured that they have. Okay, the second channel is when we're working with a non-standard risk. We will then have to approach that wholesale broker will then take our submission and go to the excess and surplus lines carrier, who will then submit a quote back to that wholesale broker, who will submit the quote to us, who then we can then present to our insured. Now, if that insured likes that proposal and they want to secure that coverage, they will notify us. We will then notify the wholesale broker, who will then notify the excess and surplus lines carrier that we want to bind the coverage. The excess and surplus lines carrier will then approve our bind request and send a proof of insurance or a binder back to the wholesale broker, which will come to us, which we can then present to our insured. Do note that just because an insured says, hey, we want to bind this coverage, and we notify that wholesale broker that we'd like to bind the coverage, there is no coverage bound until that excess and surplus lines carrier has approved our bind request and sent a proof of coverage back to us. So do note that when we work with a standard risk, if an insured tells us that they want to bind coverage and we have the binding authority, that coverage is bound the moment that they tell us. We're good to go, and that insurance carrier is bound to cover those risks. When we work with the non-standard or wholesale and E&S marketplaces, coverage is not bound until the carrier approves our bind request and sends us proof of coverage. So lastly, let's talk about some important considerations in addition to things we've talked about when we're dealing with the excess and surplus lines markets. The first, and potentially one of the most important for you when you're working with excess and surplus, is that you need to collect payment for the policy prior to binding the coverage. And this is important to protect you against having unpaid minimum premium earned premiums due to an insurance carrier. So if we bind coverage and then the insured calls us the next day and says, hey, oops, I didn't want to bind that coverage, I found coverage elsewhere, you as the agent will be on the hook for paying whatever percentage of minimum premium earned is due on that policy. So do yourself a favor and always collect payment prior to binding coverage in the excess and surplus lines world. That's a cardinal rule. Also, another thing to consider is that because excess and surplus lines is a very manual process with manual submissions of applications and the game of telephone sort of going between you and the broker and the carrier and back to you and then all of the rest of that, there's a high carrying cost. And this is not just for new business. This is for renewal business. Every year, you'll kind of be resubmitting that risk to the excess and surplus lines marketplace, and you'll have to be collecting manual applications and doing your due diligence forms and all the rest of it every year. And so just realize that this means that this business is not quite as profitable to us as some of the admitted business that we're writing that has more automatic processes. There are no downloads in excess and surplus lines, which means that we're going to be keystroke entering all of the information related to that policy into our agency management system. So a lot of times our admitted carriers contract with a third party who transfers information from their sites to our agency management system, and it will populate all the fields in our agency management system with all of the information on that policy. That does not exist in excess and surplus, so there's a manual. Again, this sort of contributes to the manual and high carrying costs, is that we have to keystroke entry a lot of the data into our agency management system. Also, we want to be thinking about how we interact with our brokers. And so we want to develop deeper relationships with 1, 2, or at most maybe 3 wholesale brokers. We want to understand that the wholesale broker, when they collect the submission from us, will go out and secure the excess and surplus lines markets, much in the same way that we would with the standard markets. And if we give a submission to multiple brokers at the same time, essentially they may get blocked from different carriers, and so you'll end up with a hodgepodge of presentations and proposals back from different wholesale brokers. And it also doesn't help a wholesale broker really access all the markets they have available, and it can erode the relationship a little bit. And so what I advise agents to do is to use your brokers in succession as opposed to at the same time. So start with your primary wholesale broker first. If for whatever reason they're unable to secure coverage or secure good terms that are acceptable to your insured, then you can move on to a second broker, but always take that marketing summary report from your primary broker, what carriers they approached and what the final outcomes were, and bring that to your second broker so that they have an understanding of the scope of work that's already been done on this and the carriers that have been approached as well. Do recognize that this is a game of telephone, so we need to collect really solid information from our insureds. We need to make and build really solid submissions for our wholesale brokers so that they can then go to the insurance carriers and secure the best possible quotes on our behalf. And so what we don't want to do is sort of have incomplete information and get stuck in this game of telephone from our insured to us, to the wholesale broker, to the carrier, back to the broker. We just want to make sure that we have all of the highest quality data and information to give to our wholesale broker so they can present really well on our behalf. And then lastly, and another very important consideration is that we want to talk about the implications of commissions and profit sharing when we're working with excess and surplus. So again, I'll start with the admitted markets or our standard markets. And oftentimes, because of our relationships and because of the size of Premier Group with these carriers, we've negotiated better than best in class frontline commissions on new business and renewal on our agents' behalf. And we have that power because we're working directly with the insurance carriers. And so we'll oftentimes see on new business anywhere from 15% frontline commission, plus we'll usually negotiate a override commission. So we might get a 5% override, and all of a sudden you're making 20% commission on a new business policy that we write through that admitted market. Additionally, at the end of the year, because of our size and because of our relationship with those admitted markets, we've secured profit sharing agreements, which means that because of our growth and our profitability at the end of the year, we get a contingency check from that carrier, which we then can proportionally split with any Premier Group agent who has a deep enough relationship with that admitted carrier that they've secured their own sub-agent code and whatnot, and we can assess their growth and profitability on an individual agent level. We then can split proportionally that profit sharing check we get with the carrier with our agents based on their growth and how they've supported our overall agency growth. So dealing with the admitted markets, recap really fast. Better than best in class front end commission. Oftentimes we get overriding and profit sharing on those agreements. So awesome way to drive revenue into your business. When we work with the excess and surplus lines markets, do note that we work through an intermediary. So that intermediary, the wholesale broker, is going to take a cut of our commission for doing their part of the process. Okay. Oftentimes our commissions on excess and surplus are anywhere between 8% and 12%, depending on the specific agreement that you have with that wholesale broker. And there will never ever be any sort of override and or profit sharing on the surplus line side. So why is that important? Well, first of all, we just discussed that there's high carrying cost to excess and surplus lines, that it's not as profitable to us because there are no automatic sort of operational, transactional types of things that are going on. So we really want to pay attention to the types of businesses that we're going to write that are going to end up in excess and surplus, because we need to make sure that they're going to provide our agency enough revenue so that we're not swamped or underwater with our efforts versus our rewards. And so writing a lot of business in the excess and surplus lines markets that's small premium is a very, very quick way to swamp your agency into a model that won't allow it to grow. So there's a purpose for writing excess and surplus lines. There's a need for writing excess and surplus lines, but it's our job as agents to be somewhat discerning about which accounts we're going to approach and work on. And we can say no when we're looking at a very small premium excess and surplus lines policy, because the amount of work that we have to put in order to secure that coverage for that client far outweighs the reward we'll get from a commissionable perspective. Now, if you get an excess and surplus lines policy that has a $100,000 premium, by all means, we can talk about writing that, but what you don't want to do is get into this case where you're writing a lot of small, 1,500, 2,500 premium policies in the excess and surplus line space, because it will sap your ability to grow. So that's our presentation on excess and surplus lines policies and marketplaces. Again, if you have more questions or just want some clarification on anything we've discussed, please reach out to your commercial lines business consultant. This person can certainly help you develop relationships with quality wholesale brokers, as well as is familiar with all of the topics of discussions in this session. And other than that, we hope that you have a great day, and please let us know how we can continue to help and support you.